Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and welcome to episode 14 of my Dow analysis series. In this video, we're going to be analyzing the 13th smallest company in the Dow by market cap, which is Salesforce Inc., ticker symbol CRM. And I'm really excited for this video because Salesforce is actually one of the youngest companies in the Dow. They were founded in 1999. And they're also one of the newest additions to the Dow, being added just back in August of 2020. So I think it should be interesting to see where they stack up. If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik. The first thing that we're going to look at for Salesforce is their 2022 10K report. So this is actually their 2022 10K because their 2022 fiscal year is already over. It's kind of strange, but that's how Salesforce works. So as they say here, they're a global leader in CRM, customer relationship management technology, that brings companies and their customers together in the digital age. We enable companies of every size and industry to take advantage of powerful technologies, including cloud, mobile, social, blockchain, and artificial intelligence, to connect their customers in a whole new way and help them transform their businesses around the customer in this digital-first world. And basically down here, they go through their different service offerings through their main Customer 360 platform. So the first of those is sales, which empowers sales teams of companies of every size and industry to manage and automate their entire sales process, from leads to opportunities to billing, allowing them to sell faster, smarter, and in the way they want. Next, they have service, which enables companies to deliver trusted and high quality personalized customer service and support at scale. Then they have some platform services, which is an easy, flexible platform that enables companies of all sizes, locations, and industries to build business apps to bring them closer to their customers with drag and drop tools. And this is something I found really interesting because I'm actually reading this book right now for one of my software engineering classes, and it's always kind of been a desire for software engineers and the software industry to make it so that you can program, quote unquote, without actually having to write code. And so this is sort of a step in that direction, and I know other companies like Google have similar services that sort of allow you to do some programming and creating some apps with sort of drag and drop things and not really coding. But I think this is a super interesting thing and has a lot of potential and is kind of moving in that direction that book was talking about. So I thought that was a pretty interesting parallel. And then the next segment they have here is Slack, which they just acquired in July 2021, which is a system of engagement that digitally connects employees, customers, partners, and systems with every application and every workflow. And then they have some marketing and commerce. So in the marketing segment, our marketing offering enables companies to plan, personalize, and optimize one-to-one customer marketing journeys, including interactions across email, mobile, social, web, and connected products. And the last one here, or one of the last ones, is commerce, which empowers brands to unify the customer experience across many points of commerce, including web, social, and store, through personalized shopping experiences and a robust partner ecosystem. The commerce offering helps companies drive increased engagement, conversion, loyalty, and revenue from their customers. And they have some things on the data side. So analytics provides customers an advanced end-to-end analytics solution serving a broad range of enterprise use cases. And finally, integration, which is powered by MuleSoft, makes it easy to connect data from any system to deliver truly connected experiences. So as you can see, they have a lot of offerings for their customers. And I think the real power of their business model and what they offer is how a company can integrate different areas of their business into kind of this one platform, and they can have a very holistic view of a lot of things while also getting down into the details as well. Next up, we are looking at their first quarter 2023 results. So like I said before, their fiscal year is a little weird. So basically, the fiscal year runs from February 1st to January 31st. And so that means the first fiscal quarter is February 1st to April 30th. So the fiscal 2023 first quarter was February 1st, 2022 to April 30th, 2022. A little bit confusing, but that's how they choose to do it, I guess. So they had first quarter revenue of $7.4 billion, which is up 24% year over year, which is super awesome to see. And the other thing that I noticed that they didn't really talk about much here was sort of revenue within their segments. And so I found this in their kind of presentation, which talks about their first quarter revenue divided by these different segments. So sales, service, platform and other, marketing and commerce, and data, those different segments that we just talked about. And we can see pretty much all of these segments had double-digit growth year over year in revenues. Some of them having, greater than 50% growth. I guess this one makes sense that they had a lot more growth because of that Slack acquisition. But lots of growth in the 15 to 25% range in all their business segments, which is really awesome to see. And it's good to see that a lot of their revenue is distributed fairly evenly among these segments. So, 1.6 billion from sales, 1.8 billion from service, 1.4 billion from platform, and around 1 billion from marketing and data, respectively. So again, their revenue is in a wide variety of their products, and all of it is growing pretty quickly, which is really good to see. And looking at earnings as well, their earnings per share for the first quarter was 98 cents, which is around a 19% decline from last year first quarter, which was around $1.20, which is not the best thing to see. And I think, for a younger company, software company like Salesforce, you're definitely going to see some fluctuation in earnings, and it's not going to be the absolute prettiest, but I think their earnings could definitely have been worse, and so I think they're doing well in general, and the earnings are reflecting that. And in terms of guidance, they're basically putting forward this guidance for the full fiscal 2023 year. So they're estimating about 20% revenue growth to around $31.7 billion of revenue, which is awesome, and they're estimating earnings per share growth of around $4.75, which would be about an 8% increase year over year from 2022. So good to see that they're, predicting increases and growth in both revenue and earnings. The top and bottom line there are growing, which is definitely a positive sign for the business. And also looking at the balance sheet, which they published in the first quarter earnings report. Right now, they are sitting around current assets of around $20 billion, which is actually down a little bit from the beginning of the fiscal year, and that's mainly due to significantly lower accounts receivable and a little bit higher cash, as well as marketable securities. So nothing too crazy going on there. In terms of the current ratio, like I said, $20 billion of current assets compared to around $19 billion of current liabilities. So they just have that current ratio greater than 1, which is really the threshold that you like to see. So it's a little bit close to that 1, but it's definitely still safe, meaning they can, pay off all of their current liabilities within the next year and not have a problem doing that. Looking at total assets, around $93 billion, and total liabilities are only at $34 billion, which if we look at their debt, it's not really that much debt. So they have about $9.5 billion in long-term debt, and then about $1 billion in short-term debt. So that gives them total debt of around $10.5 billion. And if we compare that to their total equity of $58.9 billion, $58.8 billion, I think that looks pretty good. That gives us a debt to equity ratio of around 0.18. Which is very healthy. And I think one of the things that stands out to me for Salesforce, given, we saw their earnings were decreasing a little bit in the first quarter, which is definitely not the best thing to see, but they are positioned very well in terms of their balance sheet and, where they are with their debt. So most of their financing is coming from their equity, not their debt, which means that, when times get tough, and they have to continue making those debt payments are really not going to be that big. And this is really just looking at the debt, and if we consider their net debt, they have about $10.5 billion of debt and around $6.5 billion of cash on hand. So really that's only around $4 billion in net debt, which is really not that much at all. And so I think the debt situation is really one of their strongest points for their balance sheet. and makes me pretty confident in the balance sheet as a whole. So right now, Salesforce doesn't pay any dividends, which is perfectly fine, but it's definitely something we should consider because most of the time when I'm looking at a stock to invest in, it's a dividend paying stock, and so that factors largely into my investment decision. So it's something to keep in mind, and it's kind of a shift in mindset that is required in order to evaluate Salesforce a little bit differently than we would evaluate most companies. So looking more at valuation metrics now, we can see the PE ratio over time, and this graph right here isn't very helpful because they had some time in 2018 where they had like a 10,000 PE ratio. So if we kind of take off those data points just so we can see the trend a little bit better, we can see that right now the PE ratio is around 180, which is very high for most companies. But we can see that in general, it's kind of been, all over the place. And, earnings, like I said before, have been pretty inconsistent. And so we can't really gain much insight from the PE ratio aside from saying that, right now it's pretty high, but at the same time, that is the case for a lot of newer technology companies that are really trying to grow their revenues very quickly. They aren't really focused as much on earnings. And so, the PE ratio is clearly not going to look as good in general. And this is kind of a chart of the EPS over time. So in general, it's been growing. They had it up above $4 last year in 2021. And I think in 2022 and 2023, their earnings are going to increase again. So it's definitely a good thing to see that, the earnings will decrease, the earnings will increase. And over time, hopefully it will be a little bit more steady growth and not as much fluctuation from year to year. And when we look at the overall technology sector, the average PE is about 23.2. So obviously Salesforce is very much above that. And even if we look at the software industry, their average PE is around 29. So in both cases, Salesforce is way above this. And like I said, that's kind of standard for some tech companies, but that doesn't necessarily mean that we should just not pay attention to the PE ratio. I think it's still a valuable metric. But in terms of growth companies that are a little bit younger, I think it's maybe not quite as important. And when we look at a DCF calculation to come up with a fair value, I came up with a fair value of $79.18. And if we include a 10% margin of safety, this gives us a buy price of around $71.27, which is significantly lower than the current price of around $170. And so that indicates at least that Salesforce is pretty overvalued right now. But I think there's some nuance there as well because the revenues are growing very quickly, but the income and free cash flow are not very consistent. And as a result, I had a difficult time predicting the future free cash flows. And so I tried to stay on the conservative side and not make any wild guesses. Whereas I think realistically, they can probably grow the income and free cash flow a little bit more than I predicted. And I think if they're able to sort of normalize those values and not have them fluctuate so much, not be so volatile, then we could make some better predictions. But that's one of the difficult things of using a discounted cash flow calculation is that you really need consistency in the numbers, or at least good estimates of some of those numbers in order to make a good calculation. And so again, I would say this is not necessarily the best calculation, and there's a lot of flaws inherent in it at this point. When we look at a chart of Salesforce, I think it is pretty interesting. One of the first things that I notice is that right now the price is around 170 here, and that is below pre-pandemic highs of around 190. So I think that's definitely interesting that they are below those pre-pandemic highs, whereas the overall indices still are not below those pre-pandemic highs. And they do have a lot of volume in this 150 range, so that's kind of where I would want to enter more from a technical level, I think. And when we zoom in here, we can see they have some decent support in the 150 range as well. So I think if we saw it fall closer to 150 again, that would be a much better entry point from a technical level. So overall, I think Salesforce is a pretty great company. You know, their business is growing quickly with double-digit revenue growth. In the 10, 15, 20% range, which is really awesome to see. And in general, they do have the software as a service model, with a lot of their revenue being subscription based, which is a really good model to have in general. And there's a high demand for their products, and even they're projecting even more demand in the future. One of the charts I saw somewhere in one of their earnings reports, or 10K, talks about the total addressable market for CRM software, and that is just increasing over time. And so they continue to expect the whole industry that they are in to increase, which is definitely a good thing. Another thing I like that is really a strong point for them is that they're not really burdened by debt, even though maybe their bottom line earnings numbers are not growing the best. They're really not burdened by debt, and that's not really that big of an issue from them, and that really gives them quite a strong balance sheet, in my opinion. And so obviously, like I said, they don't pay a dividend, so you have to have a little bit of a different mindset. But I think in general, the stock is a little bit overvalued. They do have a ton of potential, I think, but the price is just a bit too high. Like I said, from the technical perspective, 150 looks to be a little bit of a better price, but really I would be looking for, below 125 probably if I was really interested in investing in the company, which at this point I'm not really, just because they haven't really proven themselves enough. And, in general, I'm really not a big fan of more risky companies, but that's just kind of my preference when it comes to investing. So let me know what you guys think of the company down in the comments below. If you do have any additional thoughts, I would love to hear them. And just want to thank everyone for sticking around to the end of the video, and I'll see you all in the next one.